Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll continue with Accounting Chapter 8, Unit 2, that is Valuation of Goodwill. This is lecture number 2. Let us continue. Lecture 2, Chapter 8, Partnership Accounts, Unit 2, Treatment of Goodwill in Partnership Accounts. Next topic, accounting treatment of goodwill in case of admission of a partner. The goodwill should be recorded in the books only when some consideration in money or money's worth has been paid for it. Therefore, only purchased goodwill should be recorded in the books of the firms. Self-generated goodwill should not find place in the books of accounts. In case of admission of a partner, goodwill cannot be raised in the books of the firm because no consideration in money or money's worth is paid for it. If the incoming partner brings any premium over and above his capital contribution at the time of admission, such premium should be contributed to other existing partners should be distributed to other existing partners. When a new partner is admitted to a firm, the old partners generally sacrifice in favor of the new partner in terms of lower profit sharing ratio in the future. Therefore, the premium of goodwill brought in by the new partner shall be given to the existing partners on the basis of profit sacrificing ratio. The profit sacrificing ratio is computed by deducting the new profit sharing ratio and from the old profit sharing ratio. If the difference is positive, then there is a profit sacrifice, and in case of difference is negative, then there is again in terms of higher future profit sharing ratio. In case of admissions of a partner, only those existing partners are entitled to a share of goodwill who have sacrificed a part of their profits in favor of the new partner. Sometimes goodwill may be evaluated in case of admission of a partner when incoming partner is unable to bring in cash any premium for goodwill. In that situation also, the value of goodwill should not be raised in the books since it is inherent goodwill only. Rather, it is preferable that such a goodwill should be adjusted through partners' capital accounts only. It may also be noted that when the incoming partner pays any premium for goodwill privately to the existing partners, no entry is required in the books of the firm. In that case, the amount to be paid to each partner should be calculated as per the profit sacrificing ratio. Example 1. A, B and C are in partnership sharing profits and losses in 2:2:1. They want to admit D into the partnership for 1/5 share. D is to bring 30,000 as capital and 10,000 as premium for goodwill. The necessary journal entry will be bank account debit 30,000 for capital and 10,000 for goodwill. Bank account debit 40,000 to D's capital. D has brought 30,000 as capital, and the goodwill that D has brought is distributed between A, B and C in their old profit ratio, that is 2:2:1. So 10,000 multiplied by 2 by 5, 10,000 multiplied by 2 by 5 This is A's share, this is B's gain, and this is C, 10,000 multiplied by 1 by 5. It is 2,000, it is 4,000, and it is 4,000. A's capital account will be credited by 4,000, B's capital account credited by 4,000, C's capital account credited by 4,000. I believe you understood. Next example. Example 2. A and B are equal partners. They wanted to take C as a third partner, and for this purpose, goodwill is valued 1,20,000. The journal entry for adjustment of valuation of goodwill through partners capital account will be gaining partners account debit to sacrificing partners account. So the partner who is entering the firm is a gaining partner. C's capital account should be debited to sacrificing, that is A's capital account and B's capital account. C's share is 1 by 5, 1/3 partner. So C's share is 1 by 3. A and B will sacrifice 1/2 because they are equal partners. 1 by 3 into 1 by 2 equals 1 by 6. Same 1 by 3 into 1 by 2 equals 1 by 6. So sacrificing ratio is 1:1. Okay. A will sacrifice 1 by 6. 1 by 6 multiplied by 1,20,000, that is the value of goodwill, that is 20,000 credit. B, 1 by 6 multiplied by 1,20,000, 20,000 credit. And C is a gaining partner. So 1 by 3 multiplied by 1,20,000, that is 40,000. So gaining partners account debit to sacrificing partners. C's capital account debit 40,000, A's capital account 20,000, and B's capital account 20,000. I believe you understood. Let us continue. Example 3. A and B are equal partners. They admit C for 1/6 partner who bought 60,000 as goodwill. The new profit sharing ratio is 3:2:1. Old profit sharing ratio is 1:1. New profit sharing ratio is 3:2:1. Profit sacrificing ratio is to be computed as follows. Old share minus new share is equal to sacrifice. A's old share is 1 by 2. A's new share is 3 by 6. So 1 by 2 minus 3 by 6 is 0. No sacrifice, no gain. In case of B, old share is 1 by 2, new share is 2 by 6. 1 by 2 minus 2 by 6 is 1 by 6. So the entire goodwill should be credited to B's capital account. The entire goodwill is credited to B's capital account. So cash account will be debited 60,000 to B's capital account, 60,000. Goodwill bought by C credited to B's capital account. I believe you understood. So basically what will happen when C will bring 60,000 as goodwill, that goodwill is to be credited to B's capital account entirely. Let us move ahead. Example 4. A, B and C are equal partners. They decide to take D, who brought 60,000 as goodwill, 36,000 as goodwill. The new profit sharing ratio is 3 is to 3 is to 2 is to 2. So A, B and C were equal partners, 1 is to 1 is to 1. Old profit sharing ratio. The new profit sharing ratio is 3 is to 3 is to 2 is to 2. So 1 by 3 minus 3 by 10 is 1 by 30. Sacrifice. B sacrifice 1 by 3 less 3 by 10 is 1 by 30. C sacrifices 1 by 3 less 2 by 10 is 4 by 30. So goodwill should be shared in the ratio of 1 is to 1 is to 4. Bank account debit 36,000 to A's capital to B's capital to C's capital in the ratio of 1 is to 1 is to 4. So 36,000 multiplied by 1 by 6, 36,000 multiplied by 1 by 6 and 36,000 multiplied by 4 by 6 is 24,000. I believe you understood. Let us continue. Illustration 3. The following is the balance sheet of yellow and green as at 31st December 2016. Liabilities: trade payable, capital yellow and green on asset side, cash at bank, sundry assets. The partners shared profits and losses in the ratio of 3 is to 2. On the above date, Black was admitted as partner on the condition that he would pay 20,000 as capital. Goodwill was valued at 3 years purchase of average of 4 years profit, which were for 2012 it is 9,000, for 2013 it is 14,000, for 2014 it is 12,000, for 2015 it is 13,000. The new profit sharing ratio is 6 is to 5 is to 5. Give journal entries and balance sheet if goodwill is adjusted through partners' capital account. Solution. Calculation of profit sacrificing ratio. Profit sacrificing ratio. Old share minus new share equals share sacrificed. In case of yellow, old share is 3 by 5, new share is 6 by 16. So share sacrificed will be 18 by 80. In case of green, old share is 2 by 5, new share is 5 by 16. So share sacrificed is 7 by 80. We need to pass journal entries. So journal entries. $20,000 is Black's capital. 20,000 he bring in as capital. So bank account debited 20,000 to Black capital account 20,000. We need to value the firm's goodwill. Valuation of goodwill as per average profit method average profit equals 9,000 plus 14,000 plus 12,000 plus 13,000 divide by 4. 9,000 plus 14,000 plus 12,000 plus 13,000 equals 48,000 divide by 4. 12,000. Goodwill equals average profit into number of years purchase, which is 3 years. So 12,000 multiplied by 3 is 36,000 is the valuation of goodwill. We need to calculate new partner's share of goodwill, that is black. Black's share of goodwill equals 36,000 multiplied by new share, which is 5 by 16. 5 by 16. So this is 11,250. 11,250. Yellow's sacrifice. Yellow sacrifice is 11,250 multiplied by 18 by 25, and Green's sacrifice is 11,250 7 by 25. So 11,250 multiplied by 18 by 25 is 8,100, and 11,250 multiplied by 7 by 25 is 3,150. Eighteen and 7. This is the share sacrificed by yellow and green. In this ratio, this needs to be distributed. So second entry, gaining partner's capital account debit to sacrificing partner's capital account. So black's capital account debit 11,250 to yellow capital account 8,100 to green's capital account which is 3,150. I believe you understood this. Let us continue. Illustration 4. In the above example, with the information given in illustration 3, Let us give journal entries to prepare balance sheet. Let us give journal entries to prepare balance sheet, assuming that goodwill is brought in cash. Assuming that goodwill is brought in cash. In illustration 3, okay, making of balance sheet is pending in illustration 3. So we'll make balance sheet of illustration 3 first and then we'll move to illustration 4. Balance sheet which is required in illustration 3. Balance sheet. Balance sheet. Liabilities amount, assets amount. On asset side, cash at bank. On asset side, cash at bank. The earlier cash at bank was there 10,000 and the new partners bring in 20,000 black, so total 30,000. Next is sundry assets 55,000. Total is 85,000. Balance sheet total 85,000. On liability side, trade payable, which is given in the previous balance sheet, 20,000. And capital accounts, yellow, green, and black. Black bought in 20,000 as capital, less 11,250 contribution for goodwill. So the remaining capital is 8,750. The old capital of yellow and green were 25,000 and 20,000. 25,000 and 20,000. 25,000, 20,000. 8,100 is to be added in yellow's capital account and 3,150 is to be added in green's capital account. 25,000 plus 8,100 equals 33,100. 20,000 plus 3,150 equals 23,150. The balance sheet closed at 85,000. I believe you understood this. Let us move ahead. Illustration 4. With the information given in illustration 3, let us give journal entries and prepare balance sheet assuming that goodwill is brought in cash. Goodwill is brought in cash. This is an assumption. Solution. Journal entries. Bank account debit. Bank account debit. 30,000 brought in for 20,000 brought in for cash, 20,000 bought in for capital, and 11,250 he needs to bought in for goodwill. So total 31,250 to Black's capital account. For capital he bought 20,000 and for goodwill he brought 11,250 that is distributed between yellow and green. So to yellow's capital account, 8,100 to green capital account, 3,150. Being amount brought in by Black as capital and as goodwill. Goodwill credited. Goodwill credited to yellow and green. Green capital account in the profit sacrificing ratio. Now let us quickly make balance sheet. Balance sheet. Liabilities amount, assets amount. On asset side, cash at bank, earlier 10,000 were there and 31,250 is the new cash bought in, so 41,250. Sundry assets 55,000. Total 96,250. 96,250. Trade payables was earlier 20,000 and capital we have distributed before yellow, green and black. 33,100, 23,150 and 20,000. I believe you understood. I believe you understood till here. Next illustration, illustration 5. Continuing with the same illustration, that is illustration 3, let us give journal entries and prepare balance sheet, assuming that goodwill is brought in cash but withdrawn. Goodwill is fully withdrawn. Okay. Solution. Solution. Goodwill brought in cash but withdrawn. We have already treated up to a certain extent in the illustration 3. So only one additional entry needs to be passed. We'll pass the just additional entry, that is journal entry. Goodwill is withdrawn by the old partners, that is yellow and green. Yellow capital account debit 8,100, his share of goodwill. Green capital account debit 3,150, his share of goodwill, to bank account 11,250, to bank account 11,250. Being amount withdrawn by yellow and green in respect of goodwill credited to them. Let us make a new balance sheet. New balance sheet. Balance sheet. Asset side. Asset side and liabilities side. On the asset side, we'll begin with cash at bank. Earlier the cash at bank was 30,000. Earlier the cash at bank was 10,000. The capital bought in was 20,000. So the new cash at bank balance is 30,000. The goodwill amount, that is 11,250, that is not shown here because it is already withdrawn. Next is sundry assets. Sundry assets 55,000. Total 85,000. On the liability side, trade payables 20,000. Capital yellow, green and black. Capital yellow, green and black. The black's capital will be 20,000. Yellow and greens, the capital earlier was 25,000 and 20,000. It would be the same because for the goodwill, they have withdrawn the goodwill because there is an increase in the capital because of goodwill, but they had already withdrawn the goodwill, so capital account will decrease and will reinstate to where it was. Yellow capital account is 25,000, green's capital account is 20,000, and balance of black's capital account is 20,000. Balance sheet totaled at 85,000. I believe you understood. Illustration 6. On the basis of information given in illustration 3, let us give journal entries and prepare balance sheet assuming goodwill is paid privately. Goodwill is paid privately. Solution. There will be no entry. There will be no entry for goodwill, but Black will pay rupee 8,100 to Yellow and rupee 3,150 to Green. But because this is a private payment, it will not come into the books of accounts. I believe you understood this. Next is for capital contribution. For capital brought in, by Black, the entry is bank account debit 20,000 to Black's capital account 20,000. Let's prepare a fresh balance sheet. Balance sheet. Assets amount, liabilities amount. Cash at bank, cash at bank 10,000 was there earlier, 20,000 is bought in for capital, so total is 30,000. Sundry assets 55,000, total is 85,000. On the liability side, trade payable 20,000, capitals Yellow, Green and Black. Black's capital will be 20,000, Yellow's capital will be 25,000 and Green's capital will be 20,000. The balance sheet totaled at 85,000. Accounting treatment of goodwill in case of change in profit sharing ratio. In case of change in profit sharing ratio, the value of goodwill should be determined and preferably adjusted through capital account of the partners on the basis of profit sharing ratio. Let us quickly do illustration 7. A, B and C are equal partners. They wanted to change profit sharing ratio 4:3:2. Make the necessary journal entries of goodwill of the firm valued at 90,000. The old profit sharing ratio was equal 1:1:1. New profit sharing ratio is 4:3:2. Goodwill of the firm is valued at 90,000. Solution. sacrificing ratio formula is old ratio minus new ratio. In case of E, we'll find out sacrificing ratio 1 by 3, the new ratio is 4 by 9. 1 by 3 minus 4 by 9, we'll solve it. We'll make the denominator equal. So 3 by 9 minus 4 by 9 equals 1 by 9, and this is negative. That means this is gain. This is A's gain. In case of B, 1 by 3 minus 3 by 9. So this is 3 by 9 minus 3 by 9, nil. In case of C, 1 by 3 minus 2 by 9 multiplied by 3, this is 3 by 9 minus 2 by 9 equals 1 by 9. This is sacrifice. C is a sacrificing partner and A is a gaining partner. The goodwill is 90,000. Goodwill is 90,000. A should compensate C to the extent of 1 by 9th of goodwill, that is 90,000 multiplied by 1 by 9, 10,000. Journal entry A's capital account debit 10,000 to C's capital account 10,000. I believe you understood this. Let us continue. Illustration 8. A, B and C are in partnership, sharing profits and losses in the ratio of 4:3:3. They decided to change the profit sharing ratio to 7:7:6. Goodwill of the firm is valued at rupee 20,000. Calculate the sacrifice gained by the partners and make necessary journal entry. Goodwill of the firm is valued at 20,000. Calculate the sacrifice gained by the partners and make the necessary journal entry. Solution. Sacrificing ratio equals old ratio minus new ratio. In case of A, old ratio is 4 by 10 minus new ratio is 7 by 20. We'll make the denominators equal. 8 by 20 minus 7 by 20. It is 1 by 20 positive. This means this is sacrifice. In case of B, 4 by 3 by 10 minus 7 by 20, 6 by 20 minus 7 by 20. This is minus 1 by 20. This is negative, so it is gain. In case of C, old ratio is 3 by 10, new ratio is 6 by 20. So 3 by 10 minus 6 by 20. 6 by 20 minus 6 by 20 equals nil. B is a gaining partner, A is a sacrificing partner. The goodwill is 20,000. Goodwill equals 20,000. So 20,000 multiplied by 1 by 20, 1,000. We need to pass journal entry by 1,000. The entry would be gaining partners account debit to sacrificing partners capital account. Gaining partner is B and sacrificing partner is A. So B is capital account debit to A's capital account. Journal entry. B gained 1 by 20th share while A sacrificed 1 by 20th share, that is 20,000 multiplied by 1 by 20 equals 1,000. For C, there is no loss, no gain. There is no loss, no gain. Journal entry. B's capital account debit 1,000 to A's capital account 1,000. Being goodwill adjusted through partner's capital account in sacrificing oblique gaining ratio. I believe you understood. Let us continue. Next question, illustration 9. Illustration 9. A, B, C and D are in partnership sharing profits and losses equally. They mutually agreed to change the profit sharing ratio to 3 is to 3 is to 2 is to 2. Give necessary journal entry. So change in profit sharing ratio. Solution. In illustration 8, the goodwill of the firm is valued at 20,000 rupees. Just mention here that goodwill of the firm is rupee 20,000. sacrificing ratio equals old ratio minus new ratio. In case of A, old ratio is 1 by 2, 1 by 4, because there are 4 partners. 1 by 4 less new ratio is 3 by 10. 3 by 10 multiply this by 10, multiply this by 4. So 10 by 40 minus 12 by 40. 10 by 40 minus 12 by 40 is minus 2 by 40, minus 2 by 40. In case of B, 1 by 4 minus 3 by 10, same. Again in the same manner we will do it. In case of C, 1 by 4 minus new ratio 2 by 10, new ratio 2 by 10 multiplied by 4 over here and multiplied by 10 over here. 10 by 40 minus 8 by 40, 2 by 40. In case of D, 1 by 4 minus 2 by 10, same calculation, multiplied by 10. So this is 10 by 40, 10 by 40 upon 8 minus 8 by 40. This is 2 by 40. 2 by 40 is 1 by 20 minus 1 by 20. 2 by 40 equals minus 1 by 20. Over here 2 by 40 equals 1 by 20 and 2 by 40 equals 1 by 20. So if goodwill is valued at rupee 20,000, A and B should pay rupee 1,000 each. Rupee 1,000 each. How this 1,000 came? 20,000 is the value of goodwill multiplied by 1 by 20. That is 1,000. Pay 1,000 each as compensation to C and D for their sacrifice. For their sacrifice. I believe you understood. I believe you understood this. Let us pass journal entry now. Journal entry. A's capital account debit 1,000. B's capital account debit 1,000. A and B are gaining partners, as you can see over here. A and B both are gaining partners and C and D both are sacrificing partners. So A's capital account debit 1,000, B's capital account debit 1,000 to C's capital account 1000 to D's capital account 1000 being goodwill adjusted through partners capital account at sacrificing gaining ratio. I believe you understood. Let us continue. The next concept is accounting treatment of goodwill in case of retirement or death of a partner. In case of retirement of a partner, the continuing partner will gain in terms of profit sharing ratio. Therefore, they have to pay to retiring partner for his share of goodwill in the form of gaining ratio. Similarly, in the case of death of a partner, the continuing partner should bear the share of goodwill due to the heirs of the deceased partner. For this purpose, the goodwill is valued on the date of retirement or death of a partner and adjusted through the capital accounts of the partners. Example: A, B and C are equal partners. C wanted to retire, for which value of goodwill is considered as 90,000. The necessary journal entry is A, B and C are equal partners. So 90,000 multiplied by C's share 1 by 3, that is 30,000. This 30,000 would be shared between A and B equally, 15,000, 15,000. So gaining partners account debit to sacrificing partners capital account. A's capital account debit 15,000, B's capital account debits 15,000 and C's capital account is credit 30,000. I believe you understood. Accounting treatment of goodwill in case of retirement or death of a partner. Let us quickly do the multiple choice questions. Question 1. Goodwill bought in by incoming partner in cash for joining in a partnership firm is taken away by the old partners in their dash ratio. A. Capital ratio. B. New profit ratio. C. Sacrificing ratio. Goodwill bought in by incoming partner in cash for joining in the partnership firm is taken away by the old partners in sacrificing ratio. C. Sacrificing ratio. C. Question number 2. A and B are partners sharing profits and losses in the ratio of 5:3. On admission, C brings 70,000 cash and 48,000 against goodwill. New profit sharing ratio between A, B and C is 7:5:4. Find the sacrificing ratio of A and B. Sacrificing ratio is old ratio minus new ratio. Old ratio minus new ratio is sacrificing ratio. In case of A, old ratio is 5 by 8. In case of B, it is 3 by 8. New ratio in case of A is 7 by 16 and it is 5 by 16. If you solve this, multiplied by 2, so denominator is equal. 10 minus 7 is 3 by 16 and 6 minus 5 is 6 minus 5 is 1 by 16. Answer is A, 3 is to 1. A and B, answer is A, 3 is to 1. 2A. Question 3. Following are the factors affecting goodwill except A. Nature of business, B. Efficiency of management, C. Location of the customer. Following are the factors affecting goodwill except location of the customer. Next, question 4. Weighted average method of calculating goodwill should be followed when A. Profits has increasing trend, B. Profit has decreasing trend, C. Either A or B. It's C, either A or B. Next question, question 5. In the absence of any provision in the partnership agreement, profits and losses are shared A. In the ratio of capital, B. Equal, C. In the ratio of loans given by them in the partnership firm. It's B. Profits and losses are shared equally. I believe you understood. I believe you understood till here. We are stopping here. We are stopping here. Thank you.